Mr. Mark Selby, how are we, sir?
I'm very good, Mr. Matthew Gordon. How are you?
I'm glad to hear it. I'm glad to hear it. Now, it looks like you're on the road, or you've done your house up double quick time.
Yeah, yeah. No, I'm a little bit of a road trip. Was up at a community event in Cochrane, which is the community just north of Timmins, and then making a stop on my way back to Toronto. So
beautiful.
Good 24 hours of driving over a few days. So,
oh man, that's so much. Autonomous cars. Come on, we can't get enough of them. Sooner rather than later, eh? Hey, well, we better do our nickel thing this week. Should we start with a little bit of the market and then kind of work our way onto some of the company action that's going on out there?
Yeah. So, after 3 months of kind of leg down, the base metals as a group had a nice bounce in the past 2 weeks. So, all of them hit troughs around mid-July, but we've seen nickel move up along with copper, and we're back up over $22,000 a ton, $10 a pound. Again, there's still lots of market negativity, but the reality is inventories have continued to decline by another 5% during that time frame, and so that in combination, I think, with some hope that the Chinese are pretty committed to get their economy stimulated, even though the current numbers aren't great. Gave the bulls a chance to take a shot at it. I think realistically here, there's probably a pretty good chance, given the amount of news and the fact that the global economy is slowing down, that we will probably take another whack or two at those lows before we build a base to move higher again. So, again, I think, probably a little short-term bearish, but as I've been the whole year, it's, by the end of the year, the, demand from the EV sector is going to, basically overshadow any and all, potential slowdowns in the stainless steel side. And we should be through the worst of this from a metals perspective, and then be, on our way higher by year end. So, fingers crossed, we'll see what happens. Another little interesting tidbit, and again, I think that's helping support nickel is, we've seen cathode premiums in China get up to the highest they've ever been. So it says that, LME metal has been pretty tight, but what we've seen in the rest of the chain, and again, this is something I said back in January, is you're going to, continue to see nickel pig iron prices in China open up a gap versus the LME prices. And again, as the slowdown happens, this squeeze in Chinese NPI production looks like it's well underway. And again, I think that'll take sort of another 3 or 4 months before it sort of shakes itself out.
And so where are people, what do you think the market's looking? Because the bulk of nickel is stainless steel, but the bulk of the conversation is EV, right? So I'm sure you've got some EV update numbers on there, because I've seen a few headlines out there about we can't stop ourselves from buying electric vehicles at the moment, it seems. But sentiment-wise, with regards to the institutions that you talk to, the funders that you talk to, what are they banking on? Are they banking on the EV changing the way that the nickel market works? And in which case, have they changed their forecasts? Or quite frankly, is it the kind of slowdown in the kind of stainless steel, or this kind of, it's jumping around a bit at the moment, isn't it? Because 1 minute the economy, 1 minute the infrastructure plan is on, and the next it's slowing down, and then it's back on again.
Yeah, no, I think given interest rate, again, historically, interest rates go up, US dollar goes up, commodity prices go down. That sort of thematic is sort of hanging, pretty heavily over the sector. And so I think there are a pile of people who are still long-term, very long-term bullish, on the EV sector. Again, my view is that the unfortunate part is there's a lot of people with, who still aren't forecasting what's going to happen aggressively enough to be able to help inform, what that gap could look like. But, they are at least talking bullish. But again, right now, given this macro overhang, a lot of guys went to cash or are just basically saving whatever cash they've had to redeploy into their existing investments. And so, again, I think we'll bounce along, where we are now, through September, October. But by that fourth quarter, the EV numbers, again, despite all this recessionary talk, despite the fact people can't supply enough cars, EV sales were up 54%, year over year. Yeah, in June, we're now at 11 million plug-in car run rate versus 6 million for all of 2021. So, that's with all that background noise. And again, there's more US models coming to market by the end of 2022, 2023, actual deliveries of cars that we talked about 2 years ago. So, again, my view is we should see a further reacceleration in that number as we get into year end. And people 3 years ago were talking about 10 million EVs by 2025 and 30 million by 2030. That was kind of the numbers 2 or 3 years ago, and lo and behold, we should we're at that run rate now. We probably won't hit 10 for the year. We probably come close, but 2 years early, we're already at the 10 million run rate. So who knows where we're going to get to by that 2030 number. So
if I talk to people in the commodity space, metal space, I wouldn't know there was a recession on. And you got last week you've had Biden's staff redefining what recession means. You've got economists on one side arguing the case that we're in a recession and that we should be all terrified. And the headlines suggest that. Yet if I look at the EV space, in the metal space, it's like it ain't happening. People are spending money on brand new cars, and right now, obviously, electric vehicles, you're paying a premium for the R&D component of the car. Do we need to start redefining moments like this? Because are the variables that we are measuring so out of whack with the reality of how people spend money these days? Because it used to be, look at the shopping basket of essentials and you go, right, there you go. That defines how people should feel about the economy at the moment. And I'm struggling to make sense of it all, because I talk about less disposable income, less discretionary spend, and yet you've got this kind of runaway market sitting in the middle of this thing. What's happening?
Yeah, so I think the key here is you sometimes have a fully synchronized recession where basically every sector of the economy goes down. Slows down, stays in a trough for a while, and takes a while to come back up. In the early 2000s, we had a two-speed recession. So anything that was not tied to China's industrial development went through a typical 18 to 24 month recession. But anything tied to China, basically after the fourth quarter 2001 bounce, came roaring back. And I think that's what's going to happen here in the EV sector, is that there's, the scale of the demand strength that here is really going to help us pull off the bottom. The second part is typically in a recession, as I talked about, it's interest rates, US dollar strength, bad commodity prices. One of the things that typically precedes that is, as you get into a peak and just about the economy to roll over, mining companies have generally historically had excellent timing in making sure all the new capacity they've been working on comes on just as the economy is slowing down. So you typically see a big surge in inventories, as you head into the slowdown, which just compounds your ability to rebound out of the trough. What's different about this one is we really did not see the big investment boom that you would typically see. The majors, after they blew their brains out in the early part of the 2010s, they've tried to be prove, look at, we're free cash flow disciplined. We're not going to be those bad miners of old. We're going to use shareholders' equity very prudently. And so, they really underinvested, effectively in new supply across a range of commodities. So the thing that's different is we're heading into this downturn and slowdown with inventories for most metals close to record lows. So, as long as we don't have a massive slowdown in demand, we should, we're going to start the new cycle with almost no inventory in the hopper. And so I think it's going to be, it'll be, again, interesting to see sort of how quickly we come back next year.
So I tell you, there's something in here. I just in the back of my mind think about how this is it's a nascent industry. Okay, electric vehicles, a fairly new thing. You're always going to have the early adopters rushing to get on board and say, right, we drive an electric car, and they're going to tell all their friends and anyone who'll listen, I've got an electric car. And then there's going to be potentially, you either hope there's a kind of big groundswell of people coming up behind that who eventually catch up, or maybe because of the economy, there won't be. because people are, the bulk of the people who are not early adopter style mentality of buying will just, delay it for a while. And the other thing that worries me about the electric cars, kind of like we've seen in the mortgage markets and the credit card market, there's massive defaults in that space too, for a certain profile of buyers. So in terms of the automotive manufacturers' desire to come rushing and steaming into this space and gearing up the whole infrastructure around it, do you see that kind of hump and return to some kind of lower plateau steady run state profile? And if so, how does it affect a business like you're supplying into that space? Should we do you factor it in? Should we factor it in, or should we get comfort from the fact that the stainless steel market is massive and there's always a market for that for a company like yours?
Yes, no, I think, for sure, that's one of the benefits of nickel. It's not 100% bet just on EVs, unlike, say, cobalt or lithium or graphite, where the, huge amount of the growth is going to be all batteries. And if it doesn't quite show up quickly enough, that's going to cause some issues for those metals. I think, though, with the EV sector, we're not at the point where we're at 40% penetration and we're hoping to get to 100% penetration. We're now in the low teens, with a view that, again, all of the forecasts are, they were kind of 30% penetration by 2030, and then the bullish guys have moved up to kind of 40-ish% penetration. So we're kind of well ahead of schedule already, and there's still a significant amount of momentum. So when you're on an adoption curve, once you're on that curve and the horses have left the barn, I think there's a huge amount of push this way. And again, I think the fact that this recession is happening with crazy high oil prices because of the Russia and Ukraine conflict, that high. So for the sort of broader mass market, the fact that your gasoline prices have doubled versus where they were a year ago. Now you can plug it in and save, it's a tiny fraction of that. That's going to help people get their head around, okay, and help more of the mass market make that move over to the EV sector, than they otherwise would.
Yeah, no, I think it's definitely helping. It's a real shove, big shove from behind. High fuel prices, are the thing which just get people over the hump or jump off the cliff at that point. Is that make that commitment, but that's if the fuel prices remain. I just wonder. You talk about S-curve. I don't know what shape the curve is. That's all I'm asking. But I also want some comfort, and from you, some people, you've been working in this space for a long time, which is even if it is just a hump and then it kind of comes back down to a sort of lower steady run rate, then it's still okay. Nickel will still sell. There's still a need for it. It's not a case of the market will be oversupplied at that point. The supply demand gap is still meaningful. It doesn't affect your prices, your ability, the price at which you can sell into the market. That's all I want to get comfortable with.
No. And that, as I said, that's it. Nickel has that big second use that dominates current demand that the other materials really don't have in terms of the longer term growth range. So again, not only in terms of this, but in terms of battery technologies, if all of a sudden some great new battery technology emerges in 10 years, you're not on your investment is not going to zero because right. All of a sudden some new technology made lithium ion batteries, redundant at that point in time.
Cars run on water or grass.
Exactly.
Nightmare.
One thing actually, before we move off EVs, the comment on Biden. One thing again in this market negativity that kind of got washed out. The Biden administration has basically, as part of this bill that's going through Congress, which will hopefully go through Congress in the next few months, they are providing EV subsidies to most buyers in the United States. And what again, I think a lot of people really didn't pick up on, 30% of the content has to come from U.S. free trade agreement countries. I believe by 2027, 70% of the content has to come from U.S. free trade economies. So that means, the battery pack being the scale of in terms of the overall value of the car, that is going to provide extra incentive for car companies to find North American or other free trade agreement countries, which don't have, most of them other than Canada, don't really have a lot of nickel. And so, it's again, just the potential for North American nickel producers, has just gone a huge other massive leg up if this bill gets passed in the next few weeks here. So it just creates that much more incentive for the GM, Ford, Stellantis to be able to go and get local nickel supply, to help them meet those criteria.
Well, let's stick with EV for a second then, in terms of how that economy is building up and the investment, the hundreds of billions of dollars of investment there. Well, General Motors and Ford. So General Motors, I mean, what are they up to?
Yeah, so they've signed. We're starting to see more and more supply chain deals come into place. So they made a bunch of deals for different lithium supplies. Ford again has been signing more contracts. That they've got a stated goal where they want to produce 600,000 cars. Have had to be able to produce 600,000 ton run rate by the end of next year, and then be at 2 million cars by 2026. So again, just to underscore the scale, that's one company, who's planning to grow by nearly 3x versus where they were at the end of 2023, and from almost a zero start today. So, that you multiply that by a dozen automakers, and that should really give you a sense of, okay, yeah, there are a lot of EV cars coming down the pipe here.
Yeah, I think we spoke to one of the companies. They've signed a binding contract with Ioneer, lithium guys.
Again, in the United States. So they want, it's clear they're looking for local sources of as much material as possible.
Yeah,
so.
Amazing. Okay, let's come back to nickel proper. Okay, so I want to move on to some company news. So Aston Minerals in the news recently?
Yeah, so normally you see drill results, but it was interesting, sort of two notable pieces of met work done. So Aston Minerals is a new discovery. You've got a Crawford-like discovery just south of us in Timmins. They had done some initial work on a pretty high grade sample for these types of deposits, over 0.5%, and got good recovery. They took a slightly lower grade sample, 0.44%, and got 54% recovery. Again, that's typical for these types of deposits. But again, good to see that they're able to get those kind of recoveries. And then the other ultramafic is the awaruite deposits that you see FPX has. And so one of the key pieces there is they have done some met samples, but given this a new type of deposit, it's really important to help convince investors that across the ore body we can process this material and get decent recovery. So first off, they showed the distribution of very fine particles versus larger particles. And again, the way these deposits get formed, basically starts at a molecular level. So you can end up with a pile of very fine particles that are hard to recover. So that's why the recoveries for these deposits, are anywhere in the 40 to 60% range. And so, they showed that they were able to get decent recoveries across a range of samples, and they're continuing to do work on that front. So, again, it was very good to see. And, again, these ultramafic nickel deposits ultimately, are going to be the new source of nickel for the EV market, because they're the only big sources of nickel that have been, developed in the last 20 years.
Okay, so here's one thing for you, Mark. Again, we talked about it a little bit when we interviewed you a couple of weeks ago with Canada Nickel, and that's these carbon credits. And there's two aspects to this. It's like there's the carbon credit bit, there's the net zero bit, and / premium, nickel premium, if you can achieve that. So with the ultramafics that you've got, I think I'm beginning to get comfortable and understand how that works and why that could become part of this. But how quickly does it become part of the financial justification for projects like yours? Would you argue it doesn't need to be, but people are going to be looking to that given the carbon credit market at the moment?
Yeah, no, as I said earlier, my fundamental belief is that these types of ultramafic nickel deposits that we have, FBX, Giga, and a few other players around the world, they really need, one, large volumes of nickel. And the last high grade discovery that had 1 million tons of nickel for the entire resource was Voisey's Bay, and they need millions of tons per year by the 2030s. The second dimension is this carbon footprint. Again, our release last few weeks ago really highlighted that we think we can get to not only be zero carbon, but actually have a fairly sizable carbon, 21 tons of carbon credits per ton of nickel. And so, in terms of the financial impact, not just a green check mark for being good for the environment, but each one of those carbon credits is going to be sold for a value, and Canada is going to have $170 a ton carbon price by 2030, Canadian dollars, 120 or so US. So there's that stream of cash. And then secondly, if you have a really zero carbon product and you believe in the fact that, this is the way the world's going, there's going to be a premium for truly zero carbon products. And I've said a few times, Macquarie did this work at the last LME week in October and tried to quantify what that carbon premium looked like. And for nickel, it was $2,000 a ton. So, if you think about, okay, in our PEA, this is our cash cost and these are our premiums. Now you factor in, you're going to have, X amount of carbon credit revenue and an additional amount of premium on top. It really gets to be a very large number. Now, I don't think we'll have those as base case in our feasibility study, but we'll be able to start to demonstrate what that additional value would look like. And so, again, these types of deposits really, these types of deposits, really don't get the due they should right now. But I think, as we move, in the next year or two, and people, and again, I can tell you from our conversations with the EV supply chain, they very, very much want low carbon nickel, because again, the only alternative that's available is very, very high carbon footprint from Chinese companies in Indonesia, which doesn't meet a lot of their strategic objectives in multiple ways.
Right. So, what I wanted to add to today's conversation was for you to justify the fact that low-grade projects are economic. It's what the industry wants, whether it be battery manufacturers or other. It's what they want, and it can stand on its own 2 feet. It is attractive, and you could get that into production. You could sell that, whatever. The economics stack up, so therefore shareholders should feel comfortable with the scale of the project that you're building out. There's no fear there. But the icing on the cake here is the carbon credit bit, which I guess what you're saying is we don't need it, but given it's there,
right,
it's quite a nice thing to have. Yeah. And it helps us with achieving our objectives, which is, right, these battery manufacturers, these OEMs, they want us to be, zero carbon because they have to report on this. Yeah. If there are carbon credits attached to it, then that's good for elsewhere in their business. They could utilize those themselves. Or you can monetize that somehow. So that seems to be sort of very multi-layered, and maybe it's getting a bit too confusing, which is, I'm intrigued about how you play that going forward, because there's a massive carbon credit ecosystem happening out there, lots of confusing messages happening out there, and trying to work out what real carbon credits look like and what synthetic carbon credits look like, yeah, and whether it is $170 and what would it do if it was $17? Take a zero off. Does it matter?
Yeah.
I guess it doesn't matter to you.
No, I mean, way. To the extent, and again, we're looking at processes where, we wouldn't necessarily have to spend a lot of incremental capital or operating costs to get that number. So, any carbon credit price, will end up being, generating net revenue for us. And then the premium on top, right? That's free money. That's like, 10% higher prices And in a massive scale project like ours, if you sensitize things by 10%, that's a whole lot of additional free cash flow that hits the bottom line, and a whole lot of additional value for shareholders. So that's what being net zero is all about. That's why we started talking about it 6 months into the company, because we really believe we have a real shot at getting to a real zero carbon, not kind of a pretend, not kind of a sort of hocus pocus. This is about real carbon credits and really zero carbon nickel production.
And why now? Why does this work now? When you're Inco, trotting around the world looking at these projects, this old technology, it's been around, right? The way this works. Why is it such a big deal now? Why are people kind of latching onto it now?
Oh, I mean, 3 years ago, most companies had vague 2050 goals and were hoping that that's kind of all they needed to do in terms of carbon. And then about 18 months ago, they realized, oh, actually, consumers and investors are actually really serious about us reducing our carbon footprint. So we had to come out with more concrete plans that are getting there. And so, I think prior to 3 years ago, it didn't matter. People didn't care. It was a zero, in terms of what they were looking at, relative to most assets. But, if you believed in the energy transition, if you believe that we really are heading to a low carbon future, then the benefits of these types of, deposits that Canada Nickel has and a few other companies have, is going to be a really, really valuable asset going forward.
There you go. The secret of good comedy and good investing, timing. We had a conversation with you a couple of weeks ago, and I think a couple of comments that were left. This is in public domain, YouTube, saying this project will never become a mine. Too low grade just doesn't work. Okay. Yeah. I know we've talked about this every now and again, but I just think for new people coming in, it's worth kind of going over a bit of old ground. So how on earth does a project like yours become an economic mine, and who on earth is going to give you all of that money it's going to take to build the infrastructure to get it into production?
Yeah. So no. Obviously, that is definitely the biggest pushback. Fundamentally, high grade deposits, most of them are very small. The Koreans that we're talking to, they want hundreds of thousands of tons of nickel per year, by 2030. Most of the nickel mines that are high grade and very sexy high grade are very small. And when you look at the exploration dollars, the development dollars, the construction dollars to develop a very small nickel resource, yes, the cash cost might be okay, but your overall, net free cash flow, which at the end of the day, what matters, ends up being close to nil, if not negative. With these large low grade deposits where we're discovering millions of tons of nickel, what it comes down to very simply is don't look at the grade, don't look at the recovery. It's really how much cash do you get paid for every ton of material that you mine, and how much cost does it take to mine that ton of material. And so, in our case, it's over about $30 a ton, in the higher value years, and closer to $20 life of mine. But we can do that at just over $8 a ton. So we have 60% operating margins for 30 years. And so, it's that kind of cash flow profile, that allows you to have, that allows you to really generate, large amounts of free cash flow, and, which our PEA clearly demonstrated. In the copper space, the most analogous base metal deposit to what we're trying to do in nickel is a mine called Aitik in Scandinavia. It is the 98th percentile in grade. It's 0.2% copper with just a tiny bit of gold and silver. And that mine is basically right, at the edge of the first quartile in the cash cost curve. And it's in Finland. It's in Scandinavia, where you basically no one's going to take your mine away. The costs, input costs aren't necessarily low, but you have lower cost electricity, you have infrastructure, you have a productive workforce, and guess what? You can take that very low grade, mined at the right scale, and because we just discover deposits that are very, very large, we can build the plants that bring the operating costs down to a great unit level. And the other point, relative to the copper space is the majors don't own, small, high grade copper mines. They own great big, multi-decade, low-grade resources in safe countries. And, that's where they spend their billions of dollars to build mines that generate billions of dollars for them. And that's all we're trying to do in the nickel space.
So you're saying that the example you gave, that's one of the lowest grade projects in the world, but it's sitting at or near top quartile economics. It makes money. Because what are we saying here for people who don't understand? Because I have the same conversation whether I'm talking about uranium or gold or copper, or in this case, nickel. People just don't understand why low grade projects can work. So you're saying, I get this, the bulk, you're talking about billions of tons of rock, but your processing costs are super, super low. Why? What are you doing that ensures that the costs are super, super low?
One, it's scale, right? So we're going to be processing, we ultimately get to 120,000 tons of ore a day, which again is comparable to what the majors run in South America, or even it's on the medium size of that range, number one. Number two, we're in a place in Ontario where we have access to lower cost, low carbon electricity. So when you're grinding up lots of low grade ore, that's super helpful. And then in terms of mining operation, again, that electricity allows us to use trolley trucks, which eliminates a bunch of the diesel. And again, when you have a driver and they're driving a 40-ton truck or a 300-ton truck, your unit costs with the 300-ton truck are a lot lower. So, that's the scale of the low cost electricity. And the fact that we're in a location where people can drive to and from the mine site. So we don't have all the cost of flying workers in, flying workers out. And then finally, we're sitting in an area with all the infrastructure in place. There's highways, power lines, railways, and water. And so unlike South America, where, you're in a desolate part of a mountain range where you have to build all of those before you can even start building the mine, we've got that sort of, nearly $500 million to $1 billion worth of value already in place, which is what really drives and makes these kind of projects work. Okay,
so this is just an efficient engineering game for you. Earth moving. I get you're crushing rock, etc. But effectively, earth moving exercise in the most efficient way possible. And the scale is the thing that gives you. If you can do that, then the scale is the thing that gives you the profits, the ability to make money. And I guess ultimately for majors, they are more concerned with having multi-decade. They don't want to invest in lots of small projects. They want to invest in one big project. And once they've invested their CapEx, that's it. It's then a kind of maintenance gain, OpEx gain for them.
Yeah, exactly. Yeah.
Okay.
And then subsequent capital investments just continue to build scale to their initial existing investment. So.
Right. Interesting. I mean, I know we keep it. Sorry to go over old ground, but I just, for me, I got it after, the second or third conversation. But I think, for people out there, they like high grade anything. High grade suggests that there's a high margin, but if there's not a lot of it, then you've spent a lot of money on CapEx to mine not a lot of actual metal, and then you've got to work out what you do next. Because hard to recover that capital investment.
And I would encourage people, again, who sort of get caught up in this high grade paradigm, go look at Mincor Resources reserve and resource statement. They have literally 15 deposits. They're reopening Cassini, beautiful discovery. They have a bunch of past producers that have shut down in Cambalda and have not been running for 4 or 5 years. It littered. In that resource statement, you will see lots of deposits with 3% nickel, 4% nickel, and again, with resources, but would contain maybe 10, 20, 30, 40,000 tons of nickel. Those have not operated, and they have not operated because they cannot make money at that scale and those prices. So, please, again, I get, as I said before, a couple meters of a couple percent nickel in a new area is an exciting thing to follow up on. But it's very, very hard to turn that into any kind of resource that you can actually mine. And if you look at what's there in that Mincor resource statement, if you see a junior put out a drill interval, go look and see how it compares to all those Mincor deposits that are already sitting next to existing mining infrastructure. in most cases, and they can't make it work. So, yeah,
there you go.
It's time for a little.
So when you were at Inco and you're sort of analysing all of these projects all around the world, what was your brief? I mean, clearly they were after big projects. So how quickly could you discount assets?
Oh, pretty quickly. I mean, again, there's a cost to build a mine. That's a number. There's a mining cost when you're operating at a certain scale. And again, in places like Australia, it's not cheap. You're looking at $150 plus per ton, just a mining cost to get there. And so, again, we looked very aggressively back in the early 2000s. And yeah, it was, a great example was Jubilee Mines ended up selling for a couple $2 billion to Xstrata. Kerry Harmanis pocketed, I think, $400 million. We looked at that asset multiple times, but he did a great job promoting the company, because when you looked at the underlying asset value, it came nowhere close to what the market cap of the company was, and then he got paid a massive premium by Xstrata, who like 2 or 3 years after they bought it, actually ended up shutting down all the mines, and they've remained shut until recently. So that's
crazy.
Yeah. So.
It's crazy. I was having this conversation with Brandon this morning, also with the CEO of Endeavour Mining yesterday, about so-called experts in the space. And you think about the amount of money that's been spent or destroyed, I should say, buying projects which were just never going to work. But it didn't stop people from spending the money. I mean, I guess some people are incentivized different ways, and perhaps you don't look as hard. But when it's your own money, you look a little bit more sharply and a little bit more cautiously than I suspect when it's other people's money.
Yeah, big companies generally, they buy things that look like stuff that's been around a long time, so everyone's seen it a bunch of times and they're comfortable with it. And or they get caught up in the flavor of the month, and in 2006, 2007, all of them paid up for nickel assets. Literally, there was about half a dozen deals done within 4 months of the peak of the nickel price. They could have bought those assets for, a fifth of the price 5 years earlier, but instead they're diving in, for a couple $1 billion. And again, I think in the low grade space, the comparable ones are in Canada. We've got a Cisco, and then Detour Mines, basically around a gram per ton. They end up getting bought for close to $5 billion each, but there were long periods of time where the mining companies could have bought them for 1/4 or a fifth of the price. But again, in big gold companies, we're not sure about this, we're not sure about that. The projects did hit their bumps as they were ramping up. But today, for Agnico Eagle now owns both of them, and there's a massive part of the overall company and the overall company value. And I think the same thing's going to play out, here with the nickel. As we advance the nickel part, either we get fully into the flavor of the month and valuations go bonkers, or we'll slowly get the majors understanding what these kinds of deposits look like, and then they'll end up paying a much larger price in 2 or 3 years than they could pay for now. So.
It's incredible. Well, I think exciting times as ever. I had massive disconnects everywhere, but the signals are also everywhere. So make of it what you will, folks. I hope your investing plans are forming in your head, and you're going to time this right. Mark, appreciate you giving us an update on the nickel market. We'll see you next week.
See you next week.